Occidental Petroleum and Devon Energy reporting their fourth quarter results. Oxy's adjusted earnings per share topping estimates. It also signed 2 divestment pacts for $1.2 billion for the first quarter. Meanwhile, Devon Energy raising its quarterly dividend as company-wide production in the fourth quarter topped estimates. Here with more on the energy landscape, Tortoise Senior Portfolio Managing and Managing Director, Rob Thummel. Rob, it's great to see you here. So interesting to see these stocks trading how they are. I guess, you know, in a lot of cases, it's all about cash return. Is that why Devon's gaining here and we're not seeing the gains for Oxy? Just give us kind of your top level thoughts.
Yeah, it looks like it, Julia. So it looks like big picture in the oil and gas space right now. It's all about capital discipline. It's about returning cash to shareholders because most stocks, including these two you were talking about, Occidental and Devon, have high free cash flow yields, greater than 10%. You know, if you think about that, that's a pretty high free cash flow yield relative to the market. That's probably less than 5%. So these are always attractive stocks from that perspective. Today, or what's factoring today, it looks like that Occidental's capital spending might be a little higher than what the street expected. So we'll hear more about that tomorrow. Higher capital expenditures actually brings down that free cash flow yield a little bit for Occidental. So that's probably the biggest reason why you're seeing a little bit of after hours negative, I guess, performance on the Occidental stock relative to Devon. Is trading pretty well.
Oxy is down 18% over the past year, which is interesting given that this continues to be a favorite of Berkshire Hathaway and of Warren Buffett, who keeps adding to his stake in the company here. What's been behind that decline, and would you be following Buffett into those Occidental shares?
Well, I think it's paid off over several decades to follow Buffett. So, and you're right, he has been buying, and Berkshire continues to buy more Occidental. I think they're up to a little almost 30% ownership now. Why is the stock decline? Well, the commodity prices declined a bit, and so you've seen commodity prices lower than probably where they have been historically, at least in the last few months. And so that's contributed to a little bit. Other reasons, there has been a little bit of a sector rotation out of the more cyclical, more commodity-sensitive stocks, maybe into tech or maybe even into other areas of energy that are a little less volatile. And so I think that's why you've seen that happen. Look once again, Occidental is still a 10% free cash flow yield. It's got a little bit of a dividend yield, 2% dividend yield or so. It's lowering its debt. So it's still an attractive company to look at if you're looking at oil and gas companies and the opportunities going forward. I think what we've learned in the last maybe 5 years or so, that oil and gas is here to stay. It's going to be a significant part of the future if the global economy is going to continue to grow.
Well, and on that front, I also want to bring up Diamondback Energy, which is doing further expansion in the Permian Basin with a $4.1 billion acquisition of some more assets in that area. It's already the biggest exclusive Permian producer here. Is all of the Permian buying done at this point? Like, how much more can you move the pieces around?
Yeah, that's a good question, Julie. So you gotta like Diamondback Energy. First of all, for its ticker, it's a very interesting ticker. It's FANG is a great ticker. So, and I hope it stays around a while. But the reality is you're right. There are still some opportunities for consolidation. Exxon, Chevron, ConocoPhillips, Occidental have done lots of big deals in the Permian Basin over the last year or so, or last couple of years. And Diamondback so far has resisted and basically have been buying their own acreage. So what they're doing today and what they've done historically is effectively get a larger position, asset base, basically. So buying acreage that's close to them or that's right next to their existing acreage. Why do they do that? Well, it's because it makes them more attractive to one of these larger players someday if a larger player wants to come in and buy a large acreage position like Diamondback has. Believe it or not, oil and gas producers are producing more oil and gas, but they're also continuing to produce oil and gas more efficiently. So they're lowering the drilling costs. They're lowering the completion costs. So all that means is the break even for oil and gas producers continues to go lower. That's a good thing, I think, in the grand scheme of things, in a world where where the U.S. needs to produce more energy, the world wants more U.S. energy, but we need more low-cost energy to keep inflation low and keep commodity prices at a reasonable level for consumers.
Yeah, it seems like for these energy companies, it is a necessary thing to get those break-evens down if you've got a president telling you he wants you to produce more oil, Rob. Great to catch up with you. Hope to see you soon.